Jeff, welcome back.
Great. It's great to be here.
Happy summer. I guess we thought summer's going to be quiet. We've had a whole Israel-Iran conflict coming. Well, it's thankfully there's a bit of a ceasefire going on right now. Big, beautiful bill in the US. Still, though, the macro environment is, I would say, quite perplexing, right? Like we've had a pause in the trade war, but then again, the deadlines are looming. At the same time, the dollar has been at its lowest this year and you know, for years. More interest in assets outside of the US. And you mentioned this last time we spoke. You were very bullish about Europe. I know since then you've written a piece as well, so we can come back to that. I've sensed from some of the longer term investors, there's even interest coming back in oil. I can't even believe I'm saying these words because everybody was like, oh, oil, who cares about oil? Things are changing, and things are changing towards what you've been saying that might be happening. So maybe we start with the broader macro, right? Broader asset classes. Europe is definitely your favorite. I know people have pushed back against that with you. Yeah. So where do we stand?
I think we're in the early innings of a unwind of the capital misallocation that you can date back to '08 and arguably all the way back to the fall of the Berlin Wall. Capital is being redistributed around the world, hence why the dollar, as you point out, the weakest it's been in nearly 4 years. I think there's 3 points to this that I really want to focus on. One is during the global financial crisis, let's not forget, the U.S. had the most aggressive monetary policy and ultimately the fiscal policy. This put a lot of money on the balance sheet of the banks. They were the only ones with real functioning capital markets, the only ones with the ability of their commercial banks to create large-scale credit. And as a result, all the world's capital went to U.S. exchanges. And that was a misallocation of capital. One of the reasons why is the U.S. has the plumbing to accommodate that. But the need for that is behind us. And I think part of that weakness in the dollar is that capital being redistributed out to the rest of the world. The second one, which was really at the core of that Europe piece that we talked about, was the Mag 7. The Mag 7 were the benefits of the military-industrial complex in the United States. You know, it started with DARPA. DARPA created the internet created the AI, and so on down the line. And, you know, we look at the valuations in the U.S., they're stretched. Europe is huge discounts. Europe is now aggressively pursuing a military-industrial complex. You look at European exchanges, they've outperformed the U.S. Dollar is weaker, all pointing to a capital rotation. And then the third point really is, what's the flip side of reducing global trade? If you're reducing global trade, that means you're going to reduce the amount of capital coming into the U.S. That, you know, it's just an accounting. So if, you know, you got these deals being done with Vietnam, and so if they reduce trade going into the U.S., by definition, you're going to move capital out to the rest of the world. And I think this is the beginning of a major capital rotation, similar to what we saw in '02, '03. That's when we coined the term the revenge of the old economy, because you moved money out of the new economy or .com into the U.S. and into the BRICS. And then you saw another one in 14 and 15 when we moved it out of the BRICS and into the U.S. where it currently is right now. And I think the defining moment was Germany releasing the debt brake.
Yeah.
You know, the defining moment in 2002 was China being admitted to the WTO. This is unleashing, taking off that debt brake is unleashing pent-up fiscal capacity, pent-up industrial capacity there in Europe. So, yeah, I think this is just the beginning. And if you remember in 14 and 15, we'd walk into the office each morning and, you know, oil would be down $5 and the dollar was up 1%. Yeah. And it just went on for month after month. And I think we're in a very similar dynamic. And I think the bigger question here is, what does this do to U.S. rates? Because who's that marginal buyer of U.S. rates? But I think that the key point here, as you point out, you know, these macros want to buy oil. This is the old playbook of you know, call it, you know, '02 through 14 or 15. Again, it's the unwind of everything that really started back in '08, '09. So I think it's pretty bullish commodities.
Yeah, I mean, the picture you're painting, if it's pent up fiscal, that has to be bullish commodities. I was speaking to one of the deputy ministers, the chief economist. He's at the Saudi Ministry of Planning and Economy. In fact, he's coming for our conference. He's going to be speaking alongside you on your panel.
Great.
And he kind of raised this exact thing, the concerns even in the region, very much around the kind of weaker dollar, what that means, and the capital reallocation. And I think those are the topics that will come up, I'm sure, over the next couple of months. But like, do you see that destabilizing in terms of, say, by trade, I mean like the financial markets? Do you see that putting traders, just kind of putting fear in them and saying we're not going to trade, or this is actually a really good opportunity to buy commodities and hold on like long term?
I mean, any chart you look at commodities versus any financial market, it just ground lower and lower and lower. I mean, the bottom line is whether if it's asset heavy versus asset light, new economy, old economy, tech versus commodities, any way you slice it or dice it, that I still like the word old economy. Old economy is severely undervalued. Physical assets are severely undervalued. I felt pretty confident that this trade was really underway in 22, 23, and then it did a sharp reversal. What drove that sharp reversal was taking the fiscal debt in the U.S. up to 7%. Even this current budget is not going to go higher than where we were before. So that stimulus from the U.S. expanding the fiscal budget, I think, is behind us, which then says, hey, we need to deal with these issues and get capital back in the places where it needs to be. I don't care how bullish anyone is on AI and data centers and the rest of it. You don't have transformers, you don't have copper, you don't have the old economy to build out more AI. So you have to put money to work in this space. That's why my confidence level is quite high. And I know I sound like a broken record for the last 2.5 years, but I'm comfortable that, where we have to deal with these problems.
Well, and you don't think the new bill, the big beautiful bill going through, that doesn't just make it worse in terms of the deficit even gets bigger in the U.S. given the size of the bill and the tax?
Well, I think they kept it around 7%, 6.5%, 7%, the same place where it peaked last year. So at the margin, it's not going to get more extreme. But I think the other point is it weakens the dollar.
Yeah.
And it also, I have a big question for all of our listeners. Who's the marginal buyer of U.S. Treasuries now? It's not the Chinese. It's not the Japanese. It's not the Germans. Who is it going to be? And we're going to find out when they have to start issuing that debt to deal with this budget. So, the question is do the bond vigilantes treat Trump like they treated Bill Clinton in the 90s? We'll find out. I don't think, biggest pushback we get against that pro-European piece is the American exceptionalism.
Yes.
And that you're so wrong that it's not the end of the line for the U.S. I'm going to challenge those people out there that make that point about, the U.S. can keep doing this. Markets are telling you you're at the end of the line. When they first introduced that bill, 30-year treasuries spun out. So if you get weaker dollar, higher rates in the U.S., it reinforces growth elsewhere in the world, and growth elsewhere in the world begins to stimulate oil demand and commodities. And on that point, people will say, oh, but China doesn't have that same constraint. And I go, yeah, if you end up with a weaker dollar, the Chinese can be more aggressive because they don't have capital flight. Nobody wants to go to the U.S.
anymore, yes.
So that's why I tend to think, all of this is finally on just looking at growth patterns. Europe unleashed its fiscal capacity. China's surprising on retail sales, surprising on trade, container traffic, all of it surprising to the upside. So China's not falling apart. So bottom line is, you have a lot of macro uncertainty, but it's not translating into actual physical weakness.
I think that's a very good segue into actually what's going on in commodities. But I will say the question you raise, who is going to be the next buyer of U.S. Treasuries, is probably the most important question in the macro world that we will have to see, the answer to. But to your point, there's a narrative out there, and I think we live in this market where narratives just almost kind of take a life of its own, right? The narrative in oil has been massive oversupply, it's coming, right? Yeah. Everyone's balances, look, even our balances show an oversupply, but we've been very consistent in kind of highlighting stocks are very, very low right now. We are going to be drawing through the summer. The bills are really end of the year, but 2026. And it's not just crude. Look at products. They are super tight. And again, there are these signs, right? Supply is coming in a little bit less in every part of the world. Like today we had Canadian data, suddenly it's weak, and Latin American data is weak, and US data is weak. And like you said, the demand numbers, that the macros would tell you the demand's terrible, but it's actually not that bad.
Yeah.
And I do wonder if that's what's consistently catching people out, because there has been a persistent bearish bias in this oil market, at least this year, partly driven by kind of OPEC unwinds, but partly because I think the traders believe that with Trump wanting low oil prices, he's going to achieve it come what may.
Yep.
And yet, we're in July and we are yet to see these meaningful builds outside of China.
Yeah. And, but I think, fundamentally, we got it right. Both you and I and the remaining bulls from where we were a year ago, but we sure got the price wrong.
Yeah.
And I think that really has to do with the fact the market is just clinging to this view. But I just don't understand, why the pain they suffered going back 7 or 8 weeks ago. And then they put it on again, gluttons for punishment. And they put it on the back end of the curve, where the one thing I think I said this when we met last month was, when you have the front of the curve pricing one term structure and you try to price one into the other, it always ends in tears. Don't join the party till the party started on the front end.
Exactly.
And the front end is really tight, which means trying to put on bare structure on the back end is going to end in tears again.
And yet that's the point. I do not understand why people continue to do this. This is the third iteration maybe this year.
Yeah.
And the front is pricing at like $1.50.
Oh, it's going to end in tears. I'm very, very confident of it. But I don't know why they keep putting it on. It has to be, because it's all relative value traders. There's nobody actually taking actual risk. I don't know anybody. I only have one person I know that trades left anymore, which is probably an indication of what's going on, which probably tells you that most of the people that have this structure on, it's a hedge for something else in their book. So they don't care if they're losing. But that confidence in the bearish story is unprecedentedly high. And but it's not unique to oil. It's everything in commodity space, old economy. Nobody wants. They still are clinging to the new economy, tech, Mag 7, U.S. exceptionalism story, despite the fact that the dollar is just weakening day after day. Which I think what will have. Also, one other point before I talk about the view is, as long as I've been doing this and, following this market, which is going on 3 decades, there's only 2 times I've ever seen a supply-driven bear market, 86 and 14-15. And there was a reason. There was a market share war. There's no way you can have a market share war when everybody's cutting CapEx. So there's nothing to fight about. And there's no way, Prince Abdulaziz is going to shoot himself in the foot. It's just, there's no evidence of it. And I don't find that the level of confidence is overly surprising. And when we think about surprises in the market, every bear market is driven by a demand surprise. And what is the likelihood of demand surprising now to the upside? I think it's quite high, with the U.S. resolving a lot of these issues. You have Europe, as we talked about with fiscal stimulus, and then you have China. So I think that the risk here is decidedly to the upside.
And I think this is some of the conversations I've been having, is that yes, we can get builds. I don't think we are not going to not get builds in Q4, but it's the magnitude of that builds, right? Because stocks are so low. I mean, Cushing is bouncing around 20 to 22 million barrels. Path 3, I did the numbers yesterday. We have, or just generally in the US, we have 16 days of forward cover.
Yeah.
And then we are empty, right? None of this gives you a sign of, we are in an oversupplied market, right? So I think that's where the challenge is, that even if we build 1 million barrels per day, we kind of normalize, but that's not going to tilt us over. Now, I think that's where the bigger debate is it a 2 million build? Is it a 1 million build? And so on, right? I think that's the issue. But one of the things you said, and I think that's kind of worth picking up on, Prince Abdulaziz is not going to fight a market share in an era where capex is being cut, right? And I think that's where the macro guys are like, oh, we like oil again, because
Right.
that hasn't happened in a long time. And you and I've both been like, okay, yeah, this is not going to come back.
Yep.
So do you get the sense, I mean, we can see it in the data, right? There is no new big projects coming online. And with OPEC bringing back everything now, there's hardly going to be any spare capacity left, especially, let's say we do take the bear argument, we are oversupplied for the next 12 to 18 months. What happens in 2027?
Yeah, Goldman put out their top projects recently, and they've been doing it since '03. Very first time since they initiated the project, there was not one new project on the list. And by the way, it's not just in oil. This is upstream.
Yeah.
It's in refining. You know, you guys have your refinery database. There's nothing coming.
Nothing. Refining is a disaster. Yeah.
Right. So, by the way, that I don't know whether if I'm bullish margins or bullish crude, whatever. You're out of everything.
Yeah, exactly.
And whether if it's copper mines, that just keep going down the list. It's like they've all given up on particularly anything with carbon in it, and particularly anything old economy. So, your point about being at, I think we're going to go from this market worried about 6 million barrels per day of spare capacity to worried to zero. And here's the other thing too. Nobody's ever seen that 6 million barrels per day. And yet they have the level of confidence in that is just shocking and something they've never seen. No evidence of it. At most, if you look at export data, you probably have 2.5 million barrels per day. And also with the exports, they just went up 20 days ago. Now they're getting revised back down. Your crude is up, products are down. It's not clear that these production increases are materializing into exports.
Yeah.
So I think it was, and then all of a sudden, if OPEC goes, we have it all out on the market.
I think that's the turning point. I really do feel that way.
Yeah.
Because the export data is something we've been kind of writing a lot about and there's a genuine debate because there are some upstream operators telling us most of OPEC is already producing at the level it can. It is only Saudi Arabia that can add meaningful barrels over here. And if that's the case, that's not what our numbers are showing. We have more growth in some of the other members as well. But if that's the case, then to your point, I mean, the spare capacity number is around that, realistically, that 2.5-3 million barrels per day, not the 6. But this is why I think doing a fast forward, just 2 years, is so important. And that's also the part of the curve that's in contango.
Yes.
And I think that's where, but we need a catalyst. I think the catalyst was almost have to be OPEC's brought everything back. And then you realize, okay, there is no more to be had outside of, like, let's say, the key countries.
Yeah.
And then the market takes stock of that and realizes, oh, we actually haven't built that much inventory and we have to reprice, especially, we haven't even talked about this shale.
Yep.
It stopped growing. And I think there is not enough of a realization that the crude oil bit of shale has probably peaked or is about to peak.
But even the NGLs, the profits for the NGLs and the drilling for gas is off. Bottom line, the shale patch is just not getting the capital that it should be getting if you want to grow it. And you look at the crude production numbers, that they've stalled out. So the evidence of what everybody's been waiting for is finally here. And I like to steal a phrase from Prince Abdulaziz, who makes the point there was no growth surge in U.S. shale. It was just a recovery surge back to pre-COVID levels. And you look at pre-COVID, you hit 13, you're 13.3 or whatever it is today. You just brought production back up to where it was. They haven't grown it in 5 or 6 years. So there's a level of confidence in the shale solving all problems. And now demand situation, all the downward pressure you had from concerns about EVs and everything is subsiding. Yeah, I'm not going to discount China. China is going to continue to lower its demand, but India is going up at the same time. So all of these headwinds, whether it is U.S. shale or EVs and NGLs and all of this stuff is subsiding. And then we haven't even talked about Russia. I was with a Russian expert recently that really understands, investment there. All what little capex they have been is going into brownfield, nothing into greenfield. It's going to roll over at the end of this month or end of this year.
Oh, it's already starting to. I mean, they can't keep up with the production increase in quotas. Yeah.
And then we haven't even talked about Saudi. I'm on the board of Bore Drilling, which I think is for people looking for value purchase. It's trading at $2 a share, and it was 6 or 7 a year ago. And why? Is because concerns around Saudi drilling being off. So Saudi themselves haven't been drilling. And by the way, there's no indication, Bore just, got 4 new contracts. There's no indication the demand for these rigs is wavering like that. And we look at if Saudi, is getting towards capacity, you're going to have to pick up that drilling. So right there is nearly 50% of the world's production. None of the three are drilling. And then let's not even get into Mexico and the rest of the world, or Nigeria and the rest of them. So I really beg the question of what's going on in the U.S. is probably the tip of the iceberg of what's going on globally.
But when I speak to who you and I would consider, people who've been around trading oil, like funds, etc., for decades, there is this inherent belief, by the way, that there is not going to be a requirement for oil in the coming years. We are just in a lower demand environment. And again, I agree because of China, right? We no longer are growing at 1.5-ish million barrels per day. It's closer to 1 or sub 1, right? But I don't understand, or rather, I don't know what it would take to change that narrative. Is that going back full circle? Is that basically the fact that you get a weaker dollar, higher rates in the US, and that just distributes more demand? Because for me, when people ask me about the dollar, I said they asked me about low oil prices and the impact on oil demand. I'm like, actually, the dollar matters more. Yep. If the dollar is weaker, you actually start to get emerging market as a whole do a lot better for demand. Is that the catalyst we need to see? Because we've had, and people forget, a very strong dollar for a while, which is what has kind of weighed on kind of oil demand, commodities demand generally. Yeah. But now if you're talking about a paradigm where the dollar is weaker, maybe that's the piece that people are missing on the demand side.
By the way, if you look at EM Asian equities, they've been one of the best performing sectors in finance, and which is an indication people are thinking you're going to see that redistribution of growth and activity, and I don't discount the impact that the dollar has had. And if I go back to the 90s when I first started in this business, it was a strong dollar environment. The dollar's strongest point was '02, right before the China boom, before China was admitted to the WTO, and you saw that redistribution of capital. But it was the same dynamic there. Everybody had thrown in the towel. Nobody wanted oil anymore. Our gas was the focal point.
Really, back in '02.
Yeah, okay. And then as soon as that dollar began to weaken, the old economy came back.
So maybe that's a very good thing for all our listeners. It's because people like to go back and say, point me to a time when this was happening, so that '02 cycle would be a good. That would be a good.
By the way, it's very similar. That was when you had WorldCom and Enron, and that broadband was going to take over the world like AI is today, and you're going to have all this energy demand, and you wanted to own Calpine gas. All of that was the rah story. Oil is dead. Oh, that's interesting. Even myself, I started covering gas at that point because I thought oil was dead.
Okay. Oh, that's fascinating because I'm going to try and go back and read some of the kind of research around that.
Oh, it was identical during that time period. You just replace broadband with AI.
And it's the same thing.
Yeah, same story. Thing.
Okay, so if that's the case, I always ask you before we end, your 3 picks. If you had $100 million, you put it could be 10 as well, whatever, $10.
Yeah.
You could choose your number. What's your top 3 picks right now?
I still want to own gold.
Right? Even with everything that's gone on and the volatility?
Because if you start getting a weakening in U.S. Treasuries and a more further weakening in the dollar on top of an environment where they want to own gold anyway, because you need it for diversifying reasons, I tend to think I just don't see how it stops.
Okay.
And then copper is on a tear right now. And it has
been, and you've been bullish copper for a while.
Yeah, you're in that $5.20 a pound range right now. So I still want to own copper. If you get, the problem is you got to get the macros and the investor community on board, and they're still skeptical on China, but China's surprising to the upside. Bottom line is, where did we get wrong on China or on copper? It was the Chinese property market was much weaker than we thought. They haven't been building homes in China. It doesn't keep up with the demand for housing. They
have a big inventory as well. They're just getting rid of that instead of building new homes.
They're going to have to. It can't just keep falling. And once you stabilize that, then I think you're to the upside on copper. And oil, I'm hesitant to say it there because it's just fundamentally. You've been right, we've been right, but it doesn't matter. You need that shift in mentality, and what's going to create that shift in mentality? I do think your point is once people see, oh wow, the rest of EM Asia is doing well, then their comfort zone, I think, is going to kick in. But until that happens, I'd be a little hesitant on oil. But right now, is this copper's time? But again, I can't get people excited about it, despite the fact that the market is strong. The other thing too is because of the tariffs, so much of the world's copper is sitting inside the United States. So the rest of the world is
It's going to
choked
be
off.
tighter.
So
Yeah.
and I think if you can get one of these markets, copper or oil, to move, people go, oh, commodities are back.
Yeah. And I think oil will probably have better entry points, right? So we will eventually get it's the sell-off, right? We've been saying as well, but I think that's when that entry point for that longer dated oil comes.
Yep.
Although I will immediately add, everybody is calling for this sell-off, and when everybody says the same thing, it rarely happens, right? I think that's always the lesson.
Exactly. But I think there's another point here is energy and commodities share of financial portfolios is just so small now. People just don't care.
But they will have to, I reckon, once inflation, again, we are going to be in an environment where inflation isn't going to go away anytime soon either, right?
Not at all.
Exactly. And I think that's why, to your point, like again, gold, copper, eventually oil, not now.
Yeah.
I think those are at least the assets that you would like to own in an environment where inflation stays.
Yep.
Cool. Well, thank you, Jeff.
Great.
Always a pleasure.
Yep, it's a pleasure to be here.
And we'll catch up soon on, I'm sure, all these topics and more.
Excellent.
Yeah. Thank you.